Wondering how ETFs can fit into your portfolio? Join us for our Fall into ETF Investing event, a 4-part YouTube series premiering on October 18th, 2024, designed specifically for DIY investors. Check out these exciting weekly events we curated specifically for you, the DIY investor. Our special guest speakers and insightful industry experts will provide the information and education you need to gain confidence and empower you to manage your portfolios. You won't want to miss these weekly specials.
Hey everybody, it's Larry Berman here. Excited to finish the month of September on what looks to be a bit of an uptick in markets. You know, September, notoriously the worst month of the year, started off tragically and looked like everything was going to roll over. And then sure enough, a little bit of help from the Fed and other central banks, and we're good to go, apparently, into October, which is also, could be questionable. But, you know, more interesting than not in recent weeks, the shift in the U.S. polls, what's happening and coming out of China. Anyways, lots to unpack this week. Let's take a quick dive into the chart room and see what we learned this week. David Tepper, famed hedge fund manager out of Appaloosa, was on CNBC earlier this week saying he was, buying everything Chinese and it's undervalued. And, here's the story here. I don't know if you can follow it on, but China ripped this week, and we saw initial stimulus efforts in recent months to fail. They're very clear in front of the Chinese holiday week that this is all about the consumer versus most of the previous attempts were about driving manufacturing and industrial side. So a lot of effort by the Chinese central planners to boost the consumer, and as Tepper points out in this story, Chinese stocks are tremendously undervalued. And this is something we've talked about for a while. We've been very patient here, very frustratingly so over the past couple of years. Stops and starts. All we'll know on BNN, I've talked about NEO being a great way to play EV tech. And, while I'm up on the position after this week, it's been a painful 6 or 8 months. But we trade a lot, we move options around, we take in some extra premium. And so even though it's come down considerably in the past year or so since I, first started telling people to buy it in the low teens, my position's been worked on side. Anyways, my position really doesn't matter here. My point is China, it's a trade. Rent it, don't love it, don't marry it. For the most part, China's okay for the next decade, but the long-term demographics are just tragic. Some point between now and the next 10 years, virtual certainty that China's going to invade Taiwan and try to repo that, not unlike, hopefully, but not unlike what Mr. Putin has done in Ukraine and Georgia and other former states of the Union there, former Union. And so, that risk to me, the geopolitical thinkers that I talk to, it's all about semiconductors and making sure Taiwan has what they need onshore already before they make that move. And best case is that that's still a number of years away. So not imminent threat. And so we could see a shift into Chinese markets in the very short run. At a minimum, it's short covering, but could keep it going here for a little while. Let's have a look at the chart room and see what Chinese equity indexes are telling us. This function on the Bloomberg terminal allows me to put in ETFs and indexes and look at their price change, their total return, meaning X of dividend and income, and then annualize it. We're looking at a 5-year window of China. So pre-COVID, COVID, volatility, the liquidity of the world bump, and then the realization that China screwed up their vaccine policy and everything around that, and really just became a disaster. It was probably in and around here where most of the world was calling China uninvestable. It was probably in and around the COVID lows. So going back pretty close to 2 years, where I started saying, no, there's value here. It's cheap. And really, it's been an extremely frustrating 2 years because if we blow this up here, you can see that from a return perspective. Well, let me just do this to make it a bit easier. So on a 2-year basis, we're now making money, but all of that was made in the last few days, where up until a week ago or 2 weeks ago, you had zero gains. Now, stimulus effort, and failures. So is this one going to be the one because it's more focused on the consumer? And I think it is. So we've been building our China position throughout these periods of weakness. We maintained biggest exposure in my growth fund was Alibaba, followed by NEO. And so we trimmed those exposures late this week on Friday, mostly. JD was a big position that we've been building recently, also similar kind of exposure to Alibaba, cut that in half, but that position was 1% that kind of went, almost to 2, and now I trimmed it back to 1. So we do a lot of that in our portfolios here at Q Wealth for our clients. And I think that looking around the world and looking for where value is really key. Where it hasn't been for months and months and months is the NASDAQ, and the volatility around that continues. Now, I'm not an Elliott wave guy at all, and I think it's a very, very weak form of technical analysis. However, if I did put my technical hat on and did just a wave count here, what I get to is a 5th wave high with an ABC correction. And where does it go from here? So, if that's the case, what you do here to project where this might end up, is something like this, projected out to the end of the year, break of the 200-day average. So who knows? The U.S. election, probably. It could be a big inflection point coming up. But that's kind of what I'm seeing in the former leadership, where we have, difference when we bring up the equal weight S&P is that this guy keeps grinding higher. Now, we did get a reversal on Friday. Maybe that means something. Maybe it doesn't. Again, you see something like this and you say, okay, bearish potential. What's the follow through? But in order for this bearish potential to be realized, other than for a couple of trading days, you gotta then stop making higher highs and start making lower lows. So at a minimum, rising 200-day into October, that reversal we had here, you gotta start breaking down below 170. And if you start to see the equal weight S&P breaking down below 170, in line with this rising 200-day average and failing support into the U.S. election, which is here, then you could start to talk about a broader market breakdown and weakness. For now, the XMAG 7 names, the broader S&P, it's expanding. It's still very positive from a broader market sentiment perspective. Bloomberg strategist Gina Martin-Adams, who's also a CFA and a CMT, does really excellent work on the fundamentals of earnings, and really says that the market's underestimating where earnings are going to be going out a year. So we'll see how that all unfolds. A big thing for me for the next month is treasuries. We said why we were bearish on bonds here. It really looks like the long end of the treasury curve failed to break out here and now is back in the range. Remember, Fed rate cut, but bond market in the long end is not responding. It is concerned about inflation, and we have all this treasury supply to digest, going forward. And so, dips probably should be bought in the treasury market. I'd be surprised if the long end on TLT got back below 90 at this point. So we're dip buyers from a risk off perspective, but above 100 on TLT, we're not. Can it get in a hard landing scenario if that plays out into later 2025? The labor market is not showing anything from a layoff perspective. Initial claims, continuing claims, still, very, very positive. So we will see this week with non-farm payrolls what happens on the demand side of labor. So you have the two sides. We're laying people off. We're hiring people. The net of the two is the net change in jobs every month. And so, ADP tells us we've got new jobs. The layoffs are modest or even coming down from recent month spikes where the Fed started to get worried about the labor market. So to me, this all adds up to a slower Fed path going forward. And so when you look at what's priced in, you've got a 50-50 chance at the November meeting of a 50 basis point rate hike versus a 25. That's what this is telling us, kind of at 1.539 rate hikes, rate cuts, and 3 by the end of the year. So again, extended out a year, you're looking at, again, another 200 basis points that the bond market is pricing in right now. That's all in the front end of the curve. The long end of the curve isn't believing it or isn't seeing it or is fearful of inflation. On the Canada side here, we're now up to almost certainty that the Bank of Canada will go 50 at the October 23rd meeting, and also match the Fed in doing at least 3, this calendar year. And again, roll it out a year, and you're also talking about another significant rate cut path for the Bank of Canada, although at this point a little bit less than the U.S. catching up here. Either side, I don't think they're going to do that much going forward, and the pace is going to be slower. It's a debate to be had, to be sure, but the equity markets are pricing in, again, an awful lot of good news. But Gina Martin Adams tells us earnings are going to be there. So should be very, very interesting October as we head into the U.S. election. And on that front, Harris has really turned the recent polls this week. Whatever Trump and JD are saying are not resonating. The immigrants aren't eating dogs and cats. More and more people seem to be turned off by that rhetoric. I had some conversations at a client event earlier this week where people who are otherwise, conservatives in Canada and would be thinking, on the Republican ticket in the U.S. are very offended by the vitriol that's coming out of the Trump campaign. And so I think at this point, Harris wins. I think the Senate goes to the GOP. That seems obvious to me. The lower house is going to be very, very close. And so on election night, whatever way that tilts is really where the purse strings and the policies are going to lean towards. And frankly, and as a fiscal conservative, I hate to say it, but Harris's plan and policies are likely going to be far better for America today. I'm not talking about foreign policy. I'm talking about domestic spending plans than what Trump would otherwise want to put forth. Anyways, that's kind of my lens this week. Have a great weekend, everybody, and look for you on the golf course.